Okay, in the next few video sessions, I'm going to be talking a little bit about the principles of investing. Now, there are three key principles to investing, and we're going to start off in this video talking about the first one. And the first is markets are efficient. And what's that mean by markets are efficient? Well, essentially, the markets are very good at pricing what a security, a stock, or bond is worth at any given time. Now, is the market always completely rational? No, it's not. I mean, just last year, you can see with the big moves that were taking place up and down that the market acts on emotion a lot. But over time, it does a very good job of picking the right price for a stock or bond. And as I'll show you, it's very, very difficult for anybody to accurately and consistently beat the market to find these undervalued securities.
In the next few videos, we're going to look at the four key principles of investing. 1. Markets are efficient. 2. Minimize cost. 3. Diversify. And 4. Win by not losing. In this video, we're going to specifically look at the first principle. Markets are efficient. By efficient, what I mean is it's very difficult for you with any consistency to beat the markets. It's difficult to pick winning stocks, and it's difficult to time when to get in and out of the markets. While the markets can be very ineffective over the short term, it's still very difficult for you to exploit this advantage and make more money than the market generally returns to an investor. So the way I'm going to explain how the markets are efficient is by looking at the gambling markets. I realize that's probably shocking to hear a financial planner compare gambling to the stock market, but there are similarities into the way that they work, and it also shows you how efficient both the gambling and stock markets really are. And the way I'm going to show you that is by looking at the Notre Dame and Navy football game.
Now, when I talk about gambling and I talk about the markets being very similar, and the reason is, take Notre Dame versus Navy in football. For the past 44 years, these two teams have played football every single year. And of the past 44 years, Navy has won one time, back in 2007. So if you were going to bet on that game each year, you'd probably take Notre Dame every year, right? I mean, it makes sense. If it wins 43 out of 44 times, you'd take Notre Dame. So you'd probably make a lot of money if each year you pick Notre Dame to beat Navy. Well, actually, it wouldn't be. Because the thing is, you're not going to get anybody to make this bet with you. Nobody's going to come up and take Notre Dame even with Navy. You're going to have to give up points. That point spread makes it much more difficult to win that bet every year. Over the past 44 years, Notre Dame has beaten Navy by an average of 21 points. Now, that's a big point spread. Now, the thing is, it isn't 21 points every year that they've beaten them by. Some years they might have beaten them by 14. Some years they might have beaten them by 35. But the average is 21. So now each year, if you take Notre Dame and you give up 21 points, you probably have about a 50-50 chance of winning. So now it gets much more difficult to win that bet. Now, what people don't realize, too, is they think that bookies in Las Vegas make the point spread. That's not true either. What happens is, once the game is scheduled, the bookies will start the betting. They may pick a point, let's say 21 points. What happens is they start to getting bets in. Now, if they find there's a lot more bets on Navy than there is Notre Dame, they'll shrink that point spread. It might come down to 19 points or 18 points. Or if there's more bets for Notre Dame, it might go up to 23 or 24 points. The thing is, it's always fluctuating based on how many bets are coming in for Notre Dame and how many bets are coming in for Navy. Now, the thing is, the stock market and bond markets work exactly the same way. They sit and they have General Electric, and they see how many buys are coming in and how many sells are coming in, and they fluctuate, and they move that according to the market demands. So they're always going to be moving to make sure that there's an equal number of buys and an equal number of sells. The other thing that you have to remember is with every stock that's out there and every bond, there's a point spread. So if you think that you know the next hot stock, let's say you think it's going to be windmills or alternative energies or something like that, well, more than likely that's already been handicapped into the price of the stock. So those handicaps are always there. So you can see, just like it's very difficult to pick who's going to win a Notre Dame and Navy game each year, it's very difficult to pick which stock is going to be the best as well.
So just like it's difficult to consistently pick the winner in a sports game, it's extremely difficult to do that with the stock market as well. In fact, even the experts fail to beat the markets on a consistent basis. These high-priced, Ivy League educated mutual fund managers rarely beat the market over the longer term. In fact, this slide that you're looking at right now is showing you 10-year rolling returns from mutual fund managers in European funds, global funds, and US funds. So for example, the first point says January 03. So it's looking at all the mutual fund performance from January 93 to January 03. And the last point of October 06 goes from October 96 to October 2006. And as you can see, for all the different mutual funds out there, about 75 to 80% of these mutual funds failed to beat their benchmark. So if you're going to pick a mutual fund today, it means you have maybe at best a 2 in 10 chance that that mutual fund manager is going to be able to beat the market. It's very difficult to do. And if the financial pros can't do it with all of their knowledge and all the time that they spend doing it, just think how tough it is for you and I to do it. I always like to point out the poster child for active management. So many people who believe that you can beat the market always used to point to Bill Miller. He's the famed investor at Legg Mason, whose mutual fund beat the S&P 500 for 15 years in a row. If you look at the chart at the top here, it goes all the way from January of 91 through July of 2008. Well, for that 15-year period, Bill Miller did beat the market. And everyone around that believed in active management would point to Bill Miller saying, look, you can beat the market. Well, what ended up happening was 2006 was the first year Bill Miller failed to beat the market. In fact, he lost the market by 10%. Then in 2007, he also had a 10% lag to the market. And then last year, his fund lost 58% compared to the market's 38%. So now when you look at that streak that he had going back to 91, you actually would have been better off as an investor to have invested in an instrument tracking the S&P 500 than you would have been invested in Bill Miller's fund. Even more interesting is if you look at when Bill Miller really started investing and when his mutual fund started in 1986, well, the performance over that whole period lagged the market drastically. And in fact, it took him 5 or 6 years to even get that streak going. So here's the poster child for active management. Yet, I think the real result that comes out of this is you're better off going with a market-based investment because it is so difficult to beat the market. If the poster child for active management can't beat the market, then what are the chances that you and I can do it or that other mutual fund managers can do it? So hopefully, even from this brief example, you can see that it's very difficult to beat the markets consistently and that you're much better off going with an investment that tracks an index rather than trying to time the market or pick the next winning stock.